Hello, welcome to LSAF through Financial Accounting. Today we will be learning about control accounts. Firstly, before we begin discussing what control accounts actually are, there are two ledgers. One is called the general ledger, and the other one is the receivables ledger and payables ledger. Now what differentiates between the two is one of them is for personal accounts, the other one is for impersonal accounts. So to say that if you were to have 5 different customers and they all buy from you on credit, it is very important that you keep track of their transactions and their purchases from you. So you will record their personal accounts in the receivables ledger, and then the total sales that you have generated from these 5 customers are going to be put into control accounts, which are in the general ledger. And as you can see from this example, I've created 3 different T accounts for 3 different customers, Mr. A, B, and C. And on the debit side, I've written C.sale. It's short for credit sale. Now, for example, I made a credit sale to customer A for $200, to customer B $100, and customer C $300. Now, let's say customer A has already paid off some of that credit sale and has only paid $100. Customer B has paid off the whole thing, whereas customer C has not paid me yet, so I'm just going to leave it blank. Now, these are what is shown in the personal accounts, but what is going to be shown as a total is what I'm going to be placing in the receivables control account. Now, I'm going to be adding up all of the credit sales from my customers, so they will add up to 600, and I will be putting that in my receivables control account. Whereas for the cash figure, there should be $200. So basically, as you can see here, the control account is meant to be a reconciliation account or a matching account for the personal account. Also connecting with your sales book if it was a receivables. If it was a payables, then it would be connecting to our purchase book, because in a sales day book records credit sales, and the credit sales figure is what will go to the receivables control account. So this credit sale is supposed to match with the total of the individual personal accounts of the trade receivables that we have. And the same thing applies to our trade payables. The total credit purchases that we have shown in the purchases day book should add up to the total credit purchases that we have when we add all of our trade payables together. So if it does not match, then we need to do some rechecking. And here you can see that there is a receivable control account. As an example, I'll be going through each item and explaining what each of these mean. So as a trade receivable is classified as an asset and should be on the debit side. It would be expected that its opening balance is also on the debit side of its T account. So in here we can see that the opening debit balances are $7,000. But if you look on the credit side, which is the right side, it says that there are opening credit balances, if any, $200. Now, in rare circumstances, there is a credit balance in our trade receivables. This means that the trade receivables is a credit, or in other words, we owe them the money. These circumstances usually arise in the case where the customer has overpaid us and we owe them the extra amount in return, or perhaps they have already paid us in advance and we have not fulfilled the service yet. The next item on the left hand column is sales. Sales is a credit entry, and so it should be reflected on the debit side of the trade receivable account, because the journal entry is debit trade receivables, credit sales. Below that is dishonored bills or checks. Dishonored checks is when the customer has given a check to pay to us through the bank, but the bank has rejected their check. So and here it's put on the debit side. It means of saying that we have returned to increasing our customer's balance because we have previously reduced it, assuming that we have already received their payment, and because we assumed the check must have been approved by the bank. But then when we came to know that the bank has rejected their check, we have to bring back their debt. Below that is cash paid to clear credit balances. This is simply the cash that we have paid to clear off any credit balances on our trade receivables account. Next is interest charged on late paid accounts, which means that interest is going to increase their debt to us. Now on the right hand column, below the opening credit balance, you can see that there is a cash received. It's shown on the credit side because it means it has reduced our trade receivables balance. Next, we have discounts allowed. Discounts allowed is a way for us to encourage the customer to pay to us at a quicker rate, or just to encourage them to buy from us. So if we give them a discount, that means what they owe to us is lesser, and that's why it's on the credit side of the trade receivable account. Returns inwards is basically sales returns. So if sales is on the debit side of the trade receivable account, the return inward should be on the credit side to reflect that because our customer has returned the goods to us, they no longer owe the amount for it, and therefore they no longer have to pay for it, and we should therefore remove the debt from their accounts. The next one is the irrecoverable debts. Irrecoverable debts are times which we encounter when the customer has gone through bankruptcy or is no longer able to pay off their debt. So we're going to have to remove their balance from the total trade receivables. Now here's a payables control account. The trade payables are a liability and therefore should be a credit entry. Hence why the opening balance is on the credit side. However, as you can also see that we also have an opening debit balance. Likewise, for the same reason as for the trade receivables, this is the scenario where the trade payable owes us money. It could also be because we have overpaid to them, or they simply just owe us money because of something. Let's begin from the credit side. Purchases here are taken from the purchase day book, similar as to how the sales in the trade receivable control account was taken from the sales day book. And the purchases is put on the credit side because the more credit purchases we have, the more liability we will owe to our trade payables. The next item is interest paid on overdue accounts. Interest paid represents how much interest we are going to have to pay in addition to the amount that we already owe to our trade payables. Same reasons, this is now from the perspective as a customer because we are paying late. Next is cash received clearing debit balances. Cash received clearing debit balances is simply there to just reduce the opening debit balance that we might have. Let's move on to the debit side. Cash paid represents how much money we have already paid off to our trade payables. Because of that, it would have reduced our owing balance to them, and that's why it's on the debit side to reflect that the trade payables is now being reduced. Discounts received is similar to discount allowed. In this case, we are the ones who are receiving the discounts, and what we owe to our trade payables is now reducing. That's why it's also on the debit side. Returns outwards to suppliers. This is another name for a purchase return. So if a credit purchase is on the credit side, a purchase return should be on the debit side to show that we no longer owe for these goods and we no longer should pay for them. Now for understanding control accounts, it's best to understand that these are accounts that are put under the general or nominal ledger, are using total figures and not the individual trade payable or trade receivable himself. And better understand this, it's best not to memorize them, but to simply understand which transactions should go into which control account and understand the nature so that it's easy for you to determine whether it should be on the credit or debit side. Okay, let's take a look at this question for practice. Your payables control account has a balance at 1st October 2008 of 34,500 credit. So this is an opening balance because if you skip ahead and go to the question, they ask you what was the closing balance. So we're going to need to look for the year-end balance. So let's begin with the opening balance. The opening balance of a trade payable should be on the credit side because trade payables are liabilities. So it will look like this. During October, credit purchases were 78,400. Now let's think. Credit purchases, the double entry should be debit purchases, credit trade payables. So in this case, we are going to place it on the credit side of the trade payables like this. Cash purchases were 2,400. Now, let's ask ourselves, should we include this in a trade payables control account or not? Do not answer we should not because it was not in the format earlier, but actually it should not because when we have a cash purchase, the double entry will be debit purchases, credit cash. So it does not belong in a trade payables control account at all. And payments made to suppliers, excluding the cash purchases and after deducting settlement discounts of 1,200, were 68,900. So these are payments. Payments is when there is cash out, so we're going to have to include the payments on the debit side like this. And we also need to include our discounts like this. The reason why we need to still include discounts, even though it already says after deducting settlement discounts, can be seen from my example of a double entry right over here. So for example, I bought something for $100. So this is the original purchase price. After receiving the discount, I only owe my trade payable $80. So finally, when I do pay for my trade payable, I'm going to be paying them at the $80. Now this is also still after deducting the settlement discount, but we have originally recorded the purchase at 100, so we still need to reflect how much discount we have received to purely show why we have paid our trade payable at only $80. Next, purchase returns were $4,700. Now our purchases is on the credit side, purchase returns are on the debit side. At the end, your closing balance is going to be $38,100. Okay, let's take a look at this question. P&Co maintain a receivables ledger control account within the nominal ledger. At 30 November 2000, the total of the list of individual balances extracted from the receivables ledger was $15,800, which did not agree with the balance on the receivables control account. Now I know this is a lot of information in just 2 sentences, so let's kind of break it down a little. At what point they tell us that we have a receivables ledger control account within the nominal ledger. Nominal ledger and general ledger are the same thing, just different names. So this is correct, and the control account is maintained within the general ledger. Now what it means by this part, where it says the total of the list of individual balances extracted from the receivables ledger, is simply telling us the other ledger part.